Boom! What is up, Waves Capital? It's Royce Jacob. Welcome back to the channel. In this quick video, I want to talk to you guys about why the summer months are historically a bad time to be invested in the stock market. I want to touch on how I personally plan on trading over the remaining seasons of 2022, because we do have some fall, winter, and spring data included in this write-up as well. And lastly, I want to give you guys my downside price targets for the S&P 500 over the month of July, because the earnings season is coming in hot, and I do think that some negative reports will be the catalysts for another wave to the downside. And I actually will be recording a video later this weekend talking about some upcoming earnings and why I do think there will be a second wave to the downside for the markets. So stay tuned for that. But for now, let's focus on some historical summertime sadness data. So Waves Cap doesn't have that summertime sadness, but historically speaking, the markets do. Below, I've attached a chart of how the S&P 500 and Dow Jones Industrial Average have performed over the summer months, which are May 31st to August 31st, dating all the way back to 1981. So as you can see here, again, market performance during the summer months. Feel free, you guys, to just pause the video along the way if you want to get a good look at these. But yeah, I'm just going to keep things moving. So data reflects performance from, once again, 5/31 to 8/31 of each year. Returns are price returns and are not inclusive of dividends, fees, or transaction fees. There's definitely some red in there, but I'm seeing a lot more green. So again, take a pause. There's a lot of green in here. There's a lot of red, but there is, inarguably more green, and you can tell that just by looking at it. But there is still a significant amount of red. Both the SPX and DJIA, S&P and Dow, have finished their summers in negative territory 15 out of 39 times, or just under 40% of the time. Not bad, but definitely not good either, especially relative to how the markets have historically performed during the other 3 seasons of the year. So let's take a look at those seasons. Below, I've attached a chart of the averaged annualized returns of all 4 seasons, dating all the way back to 1958. Time would tell us that spring is the best time to invest, followed by winter, then fall, and lastly, of course, summer, with only a 2.47% average annual return. So let's take a look at this. Once again, pause it. But annualized returns, seasonal growth of $10,000 from 1958 to 2020. So a lot of history here, a lot of data. Annualized returns during the winter would be 9.65%. The spring, which is the best time of the year to invest. And again, if you guys recall, 2021, even this year, the spring was spring actually bad this year, but 2021, you guys, February, March of 2021, those are the good old days. And again, they'll be back. The market works in cycles. Just stay learning and stay growing and stay educating yourself right now. That's the main thing. But spring, historically best time to be invested in the markets with a 10.58% average return. The fall, 6.34%. And once again, summer trailing way, way, way behind all of these at a measly 2.47%. Again, the saying "sell in May and go away" is a cliche in the financial markets for a reason, right? So ending equity value, once again, just playing out the scenario of if you were to invest $10,000, winter, $41,000, spring, $47,000, fall, $25,000, and summer is $14,500. But again, that's just figurative. That's just a scenario. That's just a portfolio scenario. Again, investing $10K. So what do I take away from this from a trading perspective? Again, get into some tangible, applicable, at least takeaways that I have from this and how I might be implementing this into my personal portfolio. 1, get offensive on call options during spring and winter months. 2, chill out during the fall months with some less risky calls and prepare the portfolio for the months ahead. And 3, during the summer months, it's critical to have some put options on board to capitalize on the downside. At the same time, though, don't be afraid to hold thoughtfully selected lower risk calls as well. And of course, you guys, this is how I'm trading my personal portfolio right now. And if you guys are part of Waves Capital, if you're part of the portfolio newsletter group, you would know that this right here is definitely what the portfolio is currently looking like at this moment. Okay, so as you know, my money is where my mouth is on this, and I've pretty much just broken down my general plan of attack for the seasons ahead. Of course, this is an important caveat. There are always curveballs and exceptions to historical data. History isn't guaranteed to repeat itself, but it does tend to rhyme. This is a long game we're playing, so it's important to understand your history. Stay learning and stay growing, you guys. Okay, so once again, the fun times have definitely been fleeting over the course of 2022. Again, especially coming off of such crazy highs, coming off of such good times that were 2020, 2021. But again, you guys, the party can't go on forever. And unfortunately, the harder you party, the harder the hangover is going to be. So we are entering the hangover. But once again, there is a lot to be learned during those hanging times, during those chilly winter months. And that is when you really grow as a trader from a longer term perspective. Okay. So that said, little PSA aside, let's talk about the S&P 500, because once again, the SPY does pretty much dictate the entirety of the U.S. equity markets, or at least that's the U.S. equity markets pretty much summed up in a one chart. Okay, so the SPY, as you can see, let's get a quick price range from that all-time high that we saw at the beginning of this year. From the SPY's all-time high to the low, let's do to where we're sitting at right now. To where we're sitting at currently at the time of recording is about a 21% correction. To the low we saw a couple of weeks back is a 25% correction, or almost a 25% correction from peak to trough. Okay, but I do not think the trough is in yet. The trough is just the absolute low. My macro target for the low, and I shouldn't say macro target, but my short-term target, and I do think this will unfold over the maybe not July, but definitely by the end of August. So over the next 2 months, I think it's almost guaranteed that at the very least, the S&P 500 will come down here and revisit the initial high prior to the pandemic crash, and of course that crazy snapback rally that we've seen over the past 2 years. Okay, up until I guess a few months back, right? But anyway, the S&P 500's or the SPY's all-time high prior to that the COVID crash right there was around here at about 340. Okay, and that was coming off, if you guys see here, that is coming off a crazy rally that occurred over the course from 2017 to 2020. The SPY ripped from just, these like 2016, let's do mid 2016 to 2020, okay? So 4 years, the SPY appreciated in value by 54%. And I should say an important thing that I like to keep in mind, you guys, is the fact that the economy is in pretty rough shape right now. Again, we're coming off of highs. We are reverting to the mean, which is, again, a revisit of the initial high prior to the current rally, and or reversion to the mean. I say that a lot when we're talking about Bitcoin as well, so you guys may recognize that phrase. But reversion to the mean, a revisiting of the previous high before the current rally. So that would be about 340. But as I was just saying, it's important to remember that prior to even this crash and the crazy rally we've seen over the past couple of years, the S&P 500 has seen a very, very impressive rally just on its own. Okay, so just think to yourselves, you guys, just from a practical, reasonable perspective, do you think we are entering an economic environment and just a financial markets backdrop that is stronger than where we were in 2016, 2017, 2018? Or do you think things are going to get worse? Personally, and I'm saying this as a pretty optimistic guy, I think that the reality is things are going to be getting a lot worse, especially because we hit the brakes so damn hard. I've been talking a lot about don't fight the Fed. Again, I'll cover this more this weekend in this weekend's video. Just wrote in the newsletter this morning. Don't fight the Fed. You've got to fight with them, right? You guys, the markets were propping up. The Fed was propping up the markets so significantly over the entirety of this rally, just jamming liquidity into the markets, literally making it so the markets couldn't fall. And now they're doing the exact opposite, and they're tapering them down. They're tapering them down, or like beating them down. just to get a little more morbid, right? They're beating the markets down. They're fighting against the markets instead of fighting with them. And what I've been saying, you guys, is that we need to fight with the markets. It's very important. And of course, if you guys do want to know personally and exactly how I'm personally trading and how I'm managing the Waves Capital portfolio on a day-to-day basis, which is updated every single trading day during market hours, that is going to be the first link in the description box down below. $15 a month or $40 for every 3 months, completely up to you. And of course, along with the complete breakdown of my personal portfolio, of the Waves Capital portfolio, you do get all of the newsletters that I write every single morning. This is just one of 3 that I write every morning, you guys. Dedicate the entirety of all of my mornings, at least every trading day, every working trading day, to writing this newsletter every morning. It's great. It allows me to be a better trader and allows me to, educate myself, forcefully educate myself on the markets and bring you guys the best content that I possibly can on a day-to-day basis. And again, this is just the macro newsletter. This is 2 out of 3. The first one is my Trade Alert newsletter. Then comes the macro. And then lastly is the Price Targets newsletter. So where, of course, I include charts and whatnot and real-time price targets on a few of the most relevant names to the Waves fam that day. So if you guys want to, again, join Waves Capital, join the Waves fam. First link down below. If not, though, no worries at all. I appreciate you watching this video, and I'll catch you guys in a few days in the next one. Unless you're part of the newsletter, then I'll see you bright and early in the morning. Until then, always remember, you guys, take action, make waves. Peace.